Peter, thank you for your time. Are the Europeans back from holiday? Are we beginning to see volumes pick up globally?
They should be starting to go to holiday, at least the ones that were allowed to. Um, so, I mean, what volumes have been decent. I think people have been stuck in their homes and working from home, so working through a lot of holidays. But yeah, volumes are looking decent.
I was going to ask if we are seeing the normal August performance, if you like, versus what we've seen in the past, and we're of course talking about global performance.
No, I think I read a stat that the U.S. market had its best August for about 30 years. So normally the saying is sell in May and go away as everyone goes on holiday in the Northern Hemisphere, which is where large parts of the global market cap is located. But this year, I think there was, as I say, a lot of people stuck at home, couldn't go on holiday, and also just a lot of uncertainty, people reluctant to sort of leave their terminals for too long, I guess.
Yeah. So we continue talking about the global rally in stocks, and yet when you actually dig a little deeper, it's not quite a global rally, is it? I mean, break it down for me in terms of who has been performing better and who has not been where they ought to be.
Yeah, so it's been a very concentrated recovery from it was sort of late March when we saw the lows of the panic around the COVID crisis and the lockdowns and what that would do to economies and companies. And the recovery from that has been led by basically a handful of tech companies. So from a regional perspective, the US market is kind of ahead of the pack. I think the S&P is up over 10% now after the first couple of days of September. And by contrast, you see markets like the Euro stocks, the major European index, and the FTSE in the UK. Those are both still down 15 to 20% in local currency for those for the year. But more than being a regional phenomenon, I think it's actually more just a sector phenomenon, because within the US market, if you look at the S&P, there are sectors like energy, which is down 40%, financials, where banks have had to take massive provisions against potential bad debts. The banks are down sort of 20% for the year. So it's really just a handful of stocks. The FANGs, so all the big tech companies, Microsoft, Facebook, Amazon, Apple, and the likes. Those companies are up sort of 50% in aggregate for the year, and if you exclude those from the U.S. market, the U.S. market would be flat. So less than being it's so not so much a regional issue, because obviously these corporates earn revenues all around the globe. It's more of a sector issue that's the recovery's been very uneven.
Yeah. And where do you stand, Peter, amongst those who are debating whether there's a little bit of froth or actually a lot of froth amongst those tech companies versus what we've seen with the other parts of the economy? And I also wanted to add a little comment on that one. What are those prices that we are seeing on those tech stocks pricing in?
Yeah, so it's a difficult one, because markets always tend to go past what we think is reasonable, but I think the companies that we're talking about here are companies that are on sort of multi-year structural that have multi-year structural tailwinds as we change our behavior and become more tech savvy and do more of the things we need to do online. I think the big question mark is around how much you can extrapolate the current trends and what sort of reverses once we're all feeling comfortable about going out and about again. And so that's the big question mark, not only what sort of reverses in terms of what we're willing to do online, but also how long it takes to get there.
Yeah.
So I think these are all still great companies, and I think now the debate is around how far you can sort of extrapolate this changing behavior, and that obviously has a lot of people uncomfortable. I mean, these stocks have run. The Nasdaq 100, which is really concentrated in these things, is up 40% for the year. So it is getting uncomfortable, but it's difficult to say that it's gone too far.
Yeah, I don't know. So the other day I saw a very interesting statistic. Someone saying the value of Apple today, I think $2 trillion or thereabouts, is more than the FTSE 100 combined. And absolutely, I mean, your eyes pop when you begin to think about the valuations that are going into Apple. So let's try to find some money, Peter. Looking from here on, COVID-19 is coming down a little bit in terms of its impact, and economies are beginning again to open up a little more, but there's still a lot of uncertainty, isn't it? Where do you find your money?
So we've still got a pretty decent concentration of our offshore value in these companies, which we think have multi-year sort of structural trends behind them. As you say, the valuations are less and less comfortable every day as the markets keep climbing. But we're starting to have conversations around sectors which we think need to come back. So for example, this morning we were discussing the travel sector. And companies like Amadeus, which is a big booking engine behind many of the travel bookings, particularly in Europe.
Yeah.
And so we think people will obviously want to travel again. We don't think that that travel is done forever, but these companies are on very depressed earnings, and there's a lot of uncertainty about when they'll start making money again. But if we think of equity pricing, you're paying for sort of multi-years of earnings. You know, if we miss one or two of that, it's not cataclysmic in terms of the valuation of those companies, provided they have the balance sheet to sustain them through this lull. So we're certainly starting to look at sectors which have been shut down because of the movement restrictions, but will need to come back. People still want to travel and go on holiday, and so we're starting to look at those sectors.
Very quickly, Peter, where does that leave commodities?
Commodities is an interesting one. So iron ore is back at the levels it was in sort of early 2014 when we were still in the midst of the Chinese sort of super cycle and construction and stuff. So that's starting to look a little bit uncomfortable because we're not confident that we'll see that much sort of activity around the construction in China as we did sort of 10 years ago when they were coming off a fairly low base. So that's a little challenging. And then on the other side, the precious metals, you know, that's largely a function of what happens with interest rates and how bad that gets, I think.